Howdy, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Monday, October 24th, 2022. Starting with our economic release spotlight, we're going to spend some time talking about China, and then we'll conclude discussing the October preliminary PMI data from around the world. But just on China, so we got the Q3 and September hard data from the Chinese economy. They were confirming of our grid models sort of projections of a nascent inflection into reflation. That's where growth and inflation are accelerating simultaneously. What I think is most interesting about this sort of inflection is that you're now seeing sort of manufacturing and industry and sort of investment kind of take the baton from consumer spending as the primary driver of Chinese economic activity. And that makes sense. You got unemployment rising, and you also have broad-based deflation of Chinese household sector's primary asset. If you guessed real estate, you guessed correctly. So just unpacking some of the key highlights from the data, you had real GDP accelerate to 3.9%. That's the fastest rate we've seen since Q1 on a quarter-over-quarter basis. That also accelerated to 3.9%, which is the fastest rate we've seen since the second quarter of 2020. Industrial production ticked up to 6.3% year over year, fastest we've seen since July of 2021. Fixed assets investment ticked up to 5.9% year over year. Those are year-to-date figures, fastest we've seen since June. And then you had residential fixed asset investment accelerate as well. I mentioned the unemployment rate ticked up to 5.5%. That's the highest we've seen since May. And then you had crude oil imports actually accelerate on a rate of change basis to down 2% year over year. That's the fastest rate we've seen since May of 22. Imports were unchanged at 0.3% year over year. And then decelerating, you had a bunch of categories decelerating, particularly on the consumer side of things. Just looking at retail sales, came in at 2.5%. That's the lowest print we've seen since May. Residential property prices in first tier cities slowed to 2.7% year over year. That's the lowest we've seen since November 18. Second tier cities minus 1.2% year over year, lowest we've seen since September 15. And then third tier cities, price appreciation there declining 3.9% year over year. That's also the lowest print we've seen since September 15. So, it's very likely, at least according to our grid model, the Chinese economy will continue to improve on a trending rate of change basis. And what I mean by trending is that you're going to continue to see these intermittent bouts of zero COVID, if as evidenced by the sort of the consolidation of power that Xi has sort of cemented around himself and at the top of Chinese institutions at this Chinese Communist Party. So zero COVID is going to be here for the foreseeable future. You're not going to see a sort of uninterrupted trend of acceleration, but it's likely that base effects can carry you higher to at least the spring, where it's likely that we'll start to see some of those more classic liquidity trap fundamentals really start to weigh on Chinese growth from there. But, all told, we think this is still something, it's still very much in the category of do not touch with a 42-foot pole, because again, Chinese assets are extremely overvalued when you look at them from the perspective of the measures that we use to track relative valuations in the equity market and in the fixed income market. So be my guest if you feel like you need to go get long China there, but we would definitely be cautioning against that view. Know that's probably quite consensus, but again, consensus can and will remain right for extended periods of time, and we think this is one of those particular trades. And then shifting gears, I mentioned we got the preliminary October PMI data from around the global economy, mostly confirming our legacy views. Global growth is ubiquitously slowing. Asia's outperforming Europe, and Europe's outperforming the rest of the world broadly. So we continue to see that in the data. If you look at the economies that are above 50 and accelerating, Japan's services came in like that, above 50 and decelerating. You had Australian manufacturing, Japan manufacturing, and French services. And then below 50 and accelerating, nothing in the preliminary data. And then lastly, in the below 50 and decelerating category, you got a bunch. So Australia services, France manufacturing, Germany services, Eurozone manufacturing, Eurozone services, and then UK manufacturing and UK services. So all these things, I mean, you clearly see that most of the Europe is below 50 from a PMI perspective, which means you're in contraction from the perspective of this soft data indicator. And then shifting gears to my Lombo dashboard, we'll start with global macro, and then we'll conclude with what's signaling overbought or oversold for those of you who want to trade some of these tactical signals. To those of you who like making money on Team 42, we appreciate you because those are our favorite type of people. Lombo, so getting into our global macro dashboard here, US dollar, that is still bullish, getting close to being oversold here. Let's pull up that dollar. How much space do we have? So about 13.33, we're at 13.35 now. So an oversold dollar is not what you want to see if you're positioning for a sustained bear market rally. We're not quite oversold. Certainly you got about what is it? Sorry, we got about 0.8%. So it's about 0.2% to the low of the trading range. So maybe it augurs that, hey, if we get the low of the trading range at some point early this week, you definitely be wanting to sell risk assets into that. Gold, that's still bearish in the middle of the range there. 10-year treasury, that's still bullish, getting towards the upper boundary of the range there. It's about 4.33% to the upside there. S&P 500, that is bearish, pretty much overbought here. So got 37.86 as the upside there for the S&P 500. So not pretty much in striking distance to where we are currently. VIX, that is bullish, neutral on a short-term basis, not quite oversold. So you like to see the VIX get completely oversold there at around 28.91 before you're really starting to add some short exposure there again. NASDAQ, that's still bearish. Very similar to the S&P, getting close to the upper boundary of the range there at about 11,421 is the top side on the NASDAQ range there. Russell bearish, not quite as overbought as NASDAQ. Bitcoin, Ethereum, both still bearish in the middle of their respective ranges. Shanghai Composite, that is bearish in the middle of its range as well. WTI crude oil, that's still bearish in the middle of its range. And then agricultural bearish, not quite to the lower boundary of the range, bearish. Industrial metals are getting kind of oversold as well there, but certainly this would be a spot to be taking off some exposure from that perspective, not necessarily putting on new shorts. And then lastly, getting to my global macro dashboard where we sorted everything by the odds. So there's about 300, for those of you who are new, around 300 ETFs in here, all representing individual factor exposures across global macro. We're sorting that by the odds category to give you a sense of what's most overbought, scrolling all the way down to what's most oversold. And the key takeaway here is to sort of identify some of these sort of ETF opportunities in the markets for those of you who are tactically trading options, et cetera, things of that nature. One thing I would call out here is that investors are clearly broadly sort of not. If you look at some of the positioning dynamics that we highlighted in our crowding analysis in our lead up morning note over the last few days, if you certainly look at just general FinTwit sentiment in terms of the nature of questions I'm getting and the nature of questions I can see out there on the FinTwit sphere and the FinTwit universe, investors are really sort of positioning for another kind of round of June through August kind of bear market rally. And this is not exactly what you want to see. So we're bearish from the perspective of the Russell 1000 ETF. These are large cap US equities, but we're pretty much overbought. So you have to make the case that some real material fundamental improvement on the macro side of things needs to take place. We talked about that in great detail in Saturday's Around the Horn presentation. We got a lot of good feedback on that. So appreciate everyone for tuning into that. Definitely go subscribe if you want to get the look-see on what we discussed. But certainly this is not an overbought large cap US equity ETF at the start of Monday morning. It's probably not what you want to see in that context. But I'll leave it to you to go figure out the context from there. And then MGK. This is mega cap growth. So this is the Apples, the Teslas, et cetera, of the world getting pretty near overbought as well. So be careful out there if you're chasing the bear market rally theme narrative. These aren't necessarily the kind of signals that you want to see from a trading range perspective, from a longer range perspective, that should make you very excited about chasing. You got an overbought signal here in PICK. So for those of you, I'm going to take the other side of that with put exposure, et cetera, put spreads, et cetera. That would be a good opportunity to do that. Global Natural Resources, the GNR, not exactly looking great as well. So it's a great place to be taking off some exposure on the long side there. I know a lot of people are still long global natural resources, et cetera, on some of these sort of longer term legacy narratives. But definitely this would not be a good place to be chasing those legacy views. And then scrolling down to what's most oversold, the concept of deflation. Our friend Nancy Davis over at Quadratic, deflation, her BNDD ETF. This is oversold. One thing we talked about in the Around the Horn in terms of, we're seeing an acceleration of volatility in the long end of the treasury curve. And obviously this would be one of those products that be very much associated with that. But we have not seen an acceleration of volatility either realized or implied in equities. And so those things need to reconcile themselves just based on the kind of dynamics that we have in inflation. And ultimately we expect, there's a certain way we expect them to resolve, but we'll leave that answer, that specific answer, that guidance to our subscribers who we appreciate. So with that, Darius Dale presenting our macro minute for Monday, October 24th, 2022. Let's have a great week out there. Cheers.